Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Vinney Chopra. Vinney is a multifamily syndicator, a senior living care facility developer, an author, a podcast host, a mentor, family man. He's a lot of good things. And in just a minute, we're going to speak with Vinney about the opportunities in multifamily and senior living. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And while you're there, we appreciate you leaving a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome back a returning guest, popular guest, my friend, Vinney. Welcome back to CRE PN Radio.
Thank you, Darren. It's such a pleasure to be back there with you, brother. I think maybe during COVID, we didn't get together, did we?
I think we did once or twice, but I know we've talked at least once a year, but I know that it's been a long time, and it's time to catch up and see what you're doing. I know you've been busy, and I've met some of your students here locally.
Yes.
And I know that you've been busy selling and buying, so it's a good time to catch up.
It really is. Many times we feel what the market is doing, but you got to take action and, sell some assets at the peak and buy some in good markets and develop some. And, I'd love to share what's happening with me. Yeah.
Yeah. Why don't you start, tell us what's been going on here the last year or so.
When COVID hit 2020, we always have managed through the Zoom and through remotely and everything, meeting with our investors and so on. So that's when I got more even heavily into senior assisted living developments. And I did 5 syndications, one after the other, and raised almost $27 million to get these ground up constructions projects and started them in Florida and Virginia, and they are being built and everything. So that's something. Then I also bought a hotel with my another partner, Hilton Garden Inn, which happened before COVID actually. Oh my gosh, Darren. We closed the deal on December 31st, 2019. What a perfect timing, isn't it? And then in 2020, about April, we said, oh my gosh, our occupancy has gone down to 22%. And we were ready to pay a mortgage of $15,000 each partner, because it's a pretty big deal. Anyway, but then the office staff of the hospitals, 3 hospitals, nurses and doctors chose our hotel to live in. What is the probability of that happening? Look at that. And then our peanuts became millions because we went from 6 million we purchased in an auction, this hotel, and we are selling it in just 3 months back. This is 2022 for $11,850,000 we are selling.
Wow.
So doubling the money in that one, which is very good. And my senior livings are also going very well because what we do is we do all land development things, the ordinance changes and everything. And that gets us the land very cheap. We buy them, but by the time we have done through all the permitting, it's increased in value by 3 times already because we have gotten the permits now to build a senior assisted living. We could sell that land, but we build ourselves with our own GCs and all. And my partner has been doing it for over 10 years. So that's exciting. And then we build it in 9 to 12 months, the whole thing, 66,000 square feet to 77,000 square feet of 1 story with 88 units, 88 to 93 units. But we are not using any elevators or anything because these are 80 years to 100 years, of the age group of our residents, seniors who are living in our communities, right? It's hamptonmanor.co is our brand, Hampton Manor. And that's what is exciting. So we are building in Florida, in Virginia, in Michigan, and in St. Louis, right? Missouri. And then the good part is by the time we are done building it, we start getting residents in, like the Punta Gorda deal I'm opening up like April 1st, let's say, right? It's February. So April 1st, April Fool's Day. But we have 29 residents already given deposits to move into our apartment complex, brand new. It's being built right now. So it's a 2022 construction with everything brand new. And then we have very less deferred maintenance. And there is zero delinquency in this apartment complex because it's a need driven. And, we have to look at the residents, they have to show us 3 years of rent because usually people stay 3 years in our facilities. They go to memory care, dementia, which is also part of our division, or they get very sick, then they go to hospice and they go to rehab centers and all that. So this is a new market for me, but it's very, very satisfying market because it's apartment at its core, but it's got the feeling of helping and giving the dignity of living for our seniors.
No, that's awesome. So you mentioned the 3 years of rent up front. Is that, do they give it to you up front, or is it just to show you that they have that much?
Sure, just the proof,
Okay.
Yeah, but they only pay month by month. Yeah. No, we don't take any money up front, and they don't have to pay us any money to live in the community either. I know there are other 55 plus and independent living, places like in California where I live, where you have to pay 300,000
just to get in.
to even get in. Exactly.
Yeah.
But in our case, there's none.
Yeah. Right. Now I know that model has changed quite a bit, and I'm guessing it's kind of territorial, where some places are still that way and others are more of that. But I would guess that the model that you've got there, where it's more of just like a rent, is probably a more agreeable to people, unless the community is something that's just got a reputation, everybody wants in, and that's some sort of historical model kind of thing like that. So okay, so you've built, how many of the senior care facilities do you have? Is it 5, or how many?
Oh no, actually my partner has built over 30, but we have built together 5.
Okay.
I've got 9 more on the books.
Wow.
So I've got 14 coming up here.
Wow. And are the 5 up and running now?
No, they are being in the construction phase.
Okay.
Yeah.
Gotcha. So you're April 1 is your opening of the first one.
The first one in Punta Gorda.
Wow.
Right.
Well, that's exciting stuff. I mean, that's been a couple of years in the works here with
yes.
And a little different time frame with the construction timeline, as opposed to closing on an asset you
already built, right? I've been chasing C, B minus, B plus, A minus all this time, right? But the exciting part is that, I'm not going after working class. I'm still buying multifamily buy. I just bought in Tennessee. I'm buying some more in Florida, but those are 70 million, 80 million deals. But these ones are brand new, constructed within 17 million. What? 17 million, 18 million. I'm able to build these apartment complexes brand new for seniors.
Yeah.
Yeah.
No, that's exciting. And I just like the multiples you were saying, like from the time you guys buy the land to when you get the permits, you've tripled the value of the land. I mean, and that's just land. That's impressive. And, it's funny because I've talked with other developers and stuff, and have come to recognize that, the original value add strategy was developing, right? I mean, you start with a piece of land and you add value to it, and you
totally
make it more valuable. Well, your hotel sounds like you really I mean, that one sounds like the one that you really got away with. I mean, not got away with, but really dodged a bullet there from a
We
standpoint of
did, we
the
did.
timing to like, you bought it. I'm assuming it was a fully operational hotel. Then COVID
It
hits,
was,
and
yes.
was occupancy down to like almost nothing then, right? Right,
22%, I think, 22%.
22%.
Still, the weekend traffic was there in
Okay.
that town, some little bit business traffic, you're right. But then we also had a PIP, they call it capital improvements in
Yeah.
hotels as PIP. And then we were able to change the roof and put some little bit money into it. Then we doubled our price, and
Yeah.
sold it. We are selling it. And we are buying some more, actually. I was over there in Gatlinburg, where Dollywood is there, and that's the number 2 spot in whole USA, where a lot of people come there, for vacation and everything. After Disney World, that's number 2 spot, and people drive up there. So lots of hotels have 97% occupancies over there. So
Wow.
we are looking at different locations, and then
Uh,
storage units. What? Vinny is getting into storage
Storage
units
too.
too.
Oh my gosh. Well,
Vinny is always looking for different ways, right? So I do have my main heart is with multifamily, which I'll be keep on buying A minus or B plus assets, of course. But the compression of the cap rate has really got me thinking, in the year and a half or so, because the C class, B class, and A class, the compression of all these cap rates, it's come so close together that
right.
people are asking a lot more money for their assets. Let's call spade a spade. I mean, the deal I bought, I'm included in that, by the way. With 2020, I bought a deal in Austin, Texas, Darren, 308 units, right? Because my Melbourne property I'm collecting 98% rents from the engineers. So my engineering mind says, Vinny, where are the other engineers going? Austin, Texas. So I go there and I come into best and final on a deal with 15 other bidders, and the listing broker knows me. What? He says, Vinny, I know you. I said, hi, Michael, how are you? He says, I sold you that country club property 9 years back. You were the easiest guy to work with. I said, Michael, I'm so appreciative what you're saying. Vinny's back with more money. Literally, he told the sellers, and we had meetings and all. They awarded us the deal, my partner and I, and we got 34,750,000 we paid for 308 units near to the domain in Austin. Unheard of, totally. Got a loan from Freddie Mac at 2.69%. What? $22 million
Wow.
loan at 2.69. And the broker friend of mine just called me a few months back, in December. He says, and he's the president of a brokerage house, very big one. He says, Vinny, your property is worth 58 million today.
Oh my gosh.
Oh my gosh, from 35 million from September of 2020. And this is now January of 2022. So he told me in December, in about a year or so, the property went so high. So it's just mind blowing, mind blowing.
No, you are definitely the hits man. I mean, you've got playing the hits. You've got I mean everything you've done. I mean, I think it's interesting. The post crash.
Yes.
I mean, everything's been going up, and there've been plenty of conversations that I've had with people talking about, are we in the late innings or whatever, and
Yeah.
data. I keep talking with people that talk about just the data supports the demand for housing. And like you
Mm-hmm.
said, if you found your Melbourne property and the engineers and the demand, and you recognize
Yes.
where the other engineers going, as long as you're in that, you're in the demand.
Yes.
I think
Yes.
that's the key to it. And the
Yeah.
other question, I'm curious, how do you view the cap compression? I mean, you mentioned the fact that it makes you question, what is, or should should you stay in, should you get out, kind of thing. But I've come to recognize a compressed cap means that there is demand. And demand means that there's somebody behind you waiting to, there's somebody who wants that property. There's somebody who wants to be in that market, as opposed to if
Mhm.
you get out and it's a higher cap rate, you may not have so much demand behind you trying to get what you've got. Well, tell me a
You
little bit
know,
about how do you view it?
I would love to mention it. You know, what you're saying is so right. With compression of the cap rate, the value of the property has gone up. Even the C class, C plus or B minus, people are getting so high priced. The demand is there, supply is limited, right? Supply is limited, demand is there, and people can get cheap money. See, that's the other part. In the whole equation, the mortgage, you could get afford a bigger mortgage with bridge loans and other stuff, so the money is so cheap. But the thing is, it's the syndicators are in trouble, because if your cap rate is, let's say, 3.10 and your mortgage is at 3.5, then where is the, cash flow for the investors? So a lot of syndicators are raising money upfront, what I see in the packets, from the investors, and they're making it as a yield play and give the same money back as cash flow. I don't know if it's a Ponzi scheme or what it is.
So you're saying that they're raising more capital than they need to get the deal, but that gives them reserves so they can maintain the yield that they've
Yeah,
promised.
yeah,
Really? Huh.
exactly. And then put value add, and then maybe in a year or 2 years, the property operations will start giving the kind of returns. So I saw that coming in the last 2 years. It's been tough for me to purchase anything, by the way. I only bought one deal last year in 2021 in the multifamily space, right? But
Right.
then I tended towards senior living more, because I can build everything in 13, 14, 15 million. And it's a
Right.
brand new building. And for senior side of the operation, the rents are much higher than the regular rent, because we take care of the hotel, restaurant, right? It's a cook to order 3 meals and snacks. It's got, the movie theater. It's got spa, salon. It's got caregiving, prescription medicine, all that stuff. But we charge 4,300 starting, as compared to 1,300 in a regular apartment.
Yeah.
So my $17 million deal, brand new, is giving us 4 million revenue. See, that's where the difference is. So
Yeah.
we can get much high cap rate for building brand new apartments in assisted living. So that's something engineering mind. I've been trying to put this whole equation together. Now my goal is $2 billion in this decade to construct,
2 billion.
because then 2 billion, yeah, 2 billion, yeah.
And you're on a good pace. That's for sure. So tell me, you started multifamily. Actually, we go way back. You started single family, then you went to
Yes,
multifamily,
yes.
syndication, senior living, hotel, and now storage. What was the appeal of the storage?
Storage, space, I've looked into it quite a bit. It's very, very good. It's a multi-unit too, if you look at it, without tenants. Tenants are there, but they just come, they put their own lock on the storage unit. It's a shutter and four walls. That's all it is. There's very little deferred maintenance, and it's totally automated through cameras and everything, and through the software. They get the login, to go into the gate. And then once they are inside the storage unit, they are able to go to their storage and do their stuff and everything. So the cost of operating the self-storage unit is so low. And not only that, more and more I'm doing the research. Every zip code has many storage units. You could just say self-storage and put the zip code. You would not even believe there are so many, because within 3 miles, everybody, I think, how many, 4 out of 6, 10 families maybe need storage units. And we
Wow.
like abundance. We want to buy stuff and stuff and stuff. And, then, people move and things like, so storage has been especially very big market, and very high, good cap rates and everything, good returns. You can increase NOI. I one of my students, actually, he's doing so well. He left his IT job for storage units. He learned the business in multifamily and raising money, and now he's big time into storage units. So,
Uh,
and that's where I'm also, I'll be buying everything. Again, my diversified fund, which is right now $50 million fund, it's got 4 prongs to it. What that means is I buy already built apartments. I do the senior living ground ups. I also buy already built senior living by us into fully operational. We buy those also, buy hotels and storage units. So anybody who gives me $250,000, same money is buying all these things. So they love it because it mitigates the risk,
yeah.
because all these asset classes are there and also different locations.
Yeah. Now
So
you've definitely kind of muted the risk there by
yeah, yeah.
by doing that.
Mhm.
So let's looking forward here. I mean, I know when we first talked about it was almost 2 years ago, and COVID had just started,
Sure.
and kind of the crystal ball was, nobody knew specifically, but it was always a question of, vacancy rates. That proved not to be an issue with multifamily.
Mhm.
Um, with all of the money that's been printed and all of the demand and just the capital out there seeking a return, do you see any kind of a
Softening,
yeah,
softening.
concern? I mean, is there?
I am.
You're an engineer, a data man. Tell me what your tell
See,
me what your thoughts are.
the thing is, we are losing, dollar is losing power by putting so much pumping of the money in 2020. By the way, I think there was one statistic, we put what 60% of mint produced so many trillions of dollars in just 2020 and 2021 to give out to all these people, right? Inflation is at about 6.5% right now. Government is trying to, I think there will be some upward pressure to the interest rate. It is going to be up probably in April, I hear 0.25, maybe another one in October. So that is going to put downward pressure onto the valuation, because as the interest rate rises, you can afford less of the product. Mortgage is going to go up. Some people who are into bridge lending, and a lot of people have gone that route in the last couple of years, because they can get 80% rather than 70%, which the other Fannie, Freddie Macs were giving. A lot of people have gone into bridge lending, but then the bridge people will be also looking into how the whole equation is going to work, with these people who have bought to 80%. If the occupancy goes down, we are very close to defaults, as compared to 60%, LTV, right? So I see a downward pressure coming, but the thing is, you've got to be very, very articulate and do assumptions very conservatively, because the rents may not increase that much either. Because if the inflation is high, people have less money because they are buying, stuff and eating and gas and everything. More money is going there, so they won't be able to give the higher rents. So the rent increase will be also very, it may be only 1% increase or 2% increase, unless you are buying with a big, big gap in the rent differential, already with the value add. So I think in the crystal ball, nobody's got a crystal ball. I don't either. But I really see that the millennials, I've been talking about 3 millennials big time. One is millennial, tsunamis, 3 tsunamis, I should have said. One is millennial, 74 million of us, Z, not me, I'm a senior, but they are the ones who like portability, and they don't like to buy homes. So the renter, we're becoming a renter nation again. There are so many articles in Globe Street, in Fortune magazine, in Forbes magazine, where there is a pent-up demand for rents. Immigration tsunami is another one, because our birth rate is so low in USA. The immigration kind of helps a lot. It's going to be 441 million population in the next 30, 40 years. But where is that going to come from? is from immigration, birth, and then seniors, which is 10,000 baby boomers turning 65 every day until 2031 or 2033. 10,000 every day getting into senior riders. So that's 100 million will be seniors in America. Never ever before that has happened. So there is a pent-up demand for housing for senior living, see? So those three tsunamis are going to continue boosting our pressure into rentals. And of course, downsizing by the baby boomers, that's going to affect also because more single family will be available, of course. And then I don't know about industrial also will be on a good spur up because with warehouses and all opening up, industrial strip shopping centers are downsizing. We know that very much. Office space is downsizing, but storage units and I just realized I have these on. Oh, can you hear me okay from here?
Yeah, no, they were.
Oh, okay. Usually I do through my microphone. I had another meeting going before this one, so no problem.
So have you looked at any industrial? Is that anything you've looked at?
No. I will not be in that.
Okay.
Yeah, I wouldn't be. I think I like to stay the course in multifamily. I love the hotels because it's multifamily, and you can, look at people have to pay at the counter to stay in the room, and so forth. Storage unit is also multi-family kind of thing because each one resident owns that space, storage unit, and that way. So I'll stay in the conventional job, workhorse, our multifamily, but I'm loving the retirement communities now. So in other words, I don't have to chase jobs where Amazon is going to open up. Now I can look for demographical numbers where people want to retire in serene locations with lakes and golf courses and everything. So I'm looking for a piece of land in the neighborhoods where there are no jobs. That's why I'm in Florida and I'll be in Arizona, all the states, because people will need to retire near to their grandchildren. That's what we are finding. Even from the north, cold country, they're moving to their, children and grandchildren so that they could come and celebrate birthdays and, meet with them at the assisted living. That's the frame I'm in. I'm not into the 55 plus communities or golf courses or condominiums. I'm not in the rehab centers or nursing homes. That's a business in itself, very big medical equipments and all. I'm only in the safe environment, right in the middle, independent assisted living and memory care. We need no doctors and only one nurse, and then one chef, one helper, chef, deputy chef we call it, and then activities director and all that stuff.
No, well, I love the mix and all the success you've had, and just
thank you.
To be able to take things full cycle. I'll be interested to next time we speak to hear more about how your senior living, actually to have residents and see what you've learned there. Although I'm guessing you're probably pretty attuned to that based on your partner having been in this for so long.
We are and very vertically integrated in our senior living side also. Like I was in the multifamily, we have kind of sold so many assets, so we have dwindled down in our manpower there. In multifamily, we had 135 people full time working in my company, but now what we are doing is, before even the senior living opens, Darren, we hired the executive director and leasing agents. So my Punta Gorda, I have 29 deposits already. What? 29 seniors who have given me deposit. As soon as I open the door in 2 months from today, they'll be coming inside. And I'm going to break even within 4 months or so. I'll break even.
Wow.
Because
that's fabulous. And I just new construction, the capital improvements. I mean, you're There's no deferred maintenance or anything like that.
Zero,
That's
zero
yeah.
deferred, and all brand new appliances, all brand new floorings, brand new roof, brand new parking lot. So that saves a lot of money. And then it's A plus plus luxury living, which I built it from scratch, 2022 model. So if I were to buy an asset to give me $4 million revenue in multifamily, right? 4 million to 5 million, let's say, I may have to pay 40 to 50 million. For A plus plus, I may have to pay 100 million, by the way, 100 million for that asset, which is built brand new, which will give me 5 million revenues. But in this one, I can build it for 17 million to 18 million and have that revenue of 5 million. So it's a big equation change, and my mind shift.
Yeah.
It's really, and it's safer for my investors, And now the investors are coming ultra rich into my fold. We have 430 investors right now, but then the ultra rich are putting 1 million, 1 million, 1 million, 1 million. So in other words, they don't need cash flow at all. Darren, that's the beauty of it. So they're saying, Vinney, don't give me ordinary income cash flow, which a lot of people pay monthly and quarterly. Say, I don't need it because I'm at 50% bracket. If they give me 7.5%, half is gone in the taxes. So just give me capital gain in 3 years when you have done, semi-stabilized, your ground up construction. It's dirt first year, second year we build it, and third year we stabilize it, right? So they say, just give us the lump sum or even give us a 1031 option. So I love it. That's the key, is to just get the money right here after we have all the permits and we have a construction loan, and then we give in 2.5, 3 years, 60% return, let's say, and they can take 60% on their million, that's 600,000, or they can say, Vinney, put my 1.6 million into your next project. 1031. Then they never have to pay tax, and we can take it over and over and over again. So it's a very beautiful model that I have, devised now. I've been, designed it so that people can make 2x, even 2.5x quickly within 6 years, investing in brand new buildings. See?
Yeah.
Yeah.
So is $1 million your minimum investment in that, or is that just
no. Ultra rich. We are giving 2.5, 250,000, 500, or 1 million. So those are my 3 levels now in the ground up constructions.
Gotcha. And is that your way of doing those in more returning capital gains, or is it just on the million plus people that are saying, no, I don't want anything? Do you have different? Okay.
Even 500,000 people too. They say, Vinney, I don't need 20,000, each quarter or whatever, right? They say, if we can just give you the money and you show us the progress of everything, with what we have done so far and everything, then in 2.5 to 3 years, we'll be able to cash them out. We call them. It's cashing out, right? You get your full money back plus the return, because we'll be getting a new loan. See? Construction loan is paid out. We refinance.
Okay, then that's the event that's giving you that opportunity. Is that you've got the construction loan, then you've got a completed building with your occupancy too. So you've got now your occupancy, so you can show revenue. So you've got an NOI, and you can do like just a conventional.
Exactly.
I gotcha.
Yeah, it's like, building 17 million, it's worth 24 million. So there's a 7 million increase as I start putting, my tenants in there, residents, Yeah.
Right. No, in the like I said, the monthly the rents, I mean the cap rate there, it's pretty impressive compared to, like you said, how big of a property you'd have to buy in order to get that same kind of level of rent. So
totally.
Definitely impressive stuff. Hey, Vinney, if we could, I like to ask everybody about risk, and you've answered this question multiple times.
Yes.
But I'm kind of curious if given just your recent experience in kind of how you've changed from, asset classes, or you've expanded. I don't know, you haven't changed. You've added additional asset classes. But I'm
Yes.
wondering if there's not something that you can look at across the spectrum of what you've invested in, and just identify what you consider to be the biggest risk of
Mhm.
of just the current marketplace, or let me ask you this: what do you see is the biggest risk that you face in this marketplace, and just kind of the near future, as you work with your investors and trying to
Totally. Totally.
steward for their money?
Totally. I'm so glad you're asking that. I've raised like close to 200 million or so. But you're right. Investors want to say, Vinny, what if when you die, or something happens to you, right? What's the risk involved in that? And then when I took the key man's insurance, and then our daughter is in it now, she'll step up as president. My wife is also into it. Our legal, team and everybody, our accounting department is set. The other part is, Darren, the properties we buy. So there is insurance to be gotten at every point of the property, the loss of income insurance. Those are the risks also. If some burning, something fire comes or like that. So that is other risk. The other risk which I got hacked, I think I might have mentioned, is the cybersecurity risk. And that's a big one nowadays, with everything going through the computers and everything. So, there are so many different directors insurance risk is another one. The big thing is contractors who work with us to do capex jobs and everything. We try to save money, but it's not worth saving money unless we want to make sure contractors are well bonded and also have, like, millions of dollars of insurance, right? When they come to work at our assets. I don't know if that's the question you were really posing. The biggest risk I find is that you want to do legal way to raise money and then take care of the investment of the investors, fiduciary responsibilities we have, right? So as a CEO, I definitely have always felt each asset I bought 37 now or something, and I'm on the loan on all 37, not too many GPs, co-GPs or anything. I don't believe in that. Maybe just three I have done it, and then with my partner in division now, and, like that. But other 27 or 8, I was the only person. But, the key thing is you got to mitigate the risk for investors and mitigate the risk for the well-being of your company. So you are in the right business. You are, Jared, because insurance, it's an investment. I always look at it as an investment. It's not an expense, because I had lawsuits of $3 million, $4 million lawsuits, which because of insurance, I walked away with giving zero money. And they settled, they mediated, and all that stuff. So when you are in a business entrepreneur like me and anybody, there are risks involved in people suing you and other stuff like that. So I always feel insurance is an investment. Yeah.
No, I appreciate you sharing that, and I think that oftentimes the focus is how to make money on the buy and the sell and all that, and the insurance gets looked at as more of just an expense kind of
Mm-hmm.
thing, as opposed to the protection. It
Mm-hmm.
messes up your NOI if you have too much insurance expense kind of thing.
Sure.
And
Sure.
but the flip side, like you said, is there's the protection you get, and
Mm-hmm.
when you are facing a claim, that's when you really
Yes.
want to know you've got some good insurance. So appreciate
So
that.
true. So true.
So Vinny, where can the listeners go if they'd like to learn more or connect with you?
Oh my gosh, I've got a really great promotion going on right now. I'm so glad. I wrote that book, Apartment Syndication Made Easy, which really helped me a lot to raise money. And I'm giving this book free, by the way, to everybody listening or watching us. You could go to vinneychopra.com. That's my website, www.Vinney, just like the word Vinney, not smile. Don't put smile in there, but VinneyChopra.com and /free book. And I also have Academy. I also have a $50 million 506 C fund where I can talk about it and everything. It's for accredited investors only. If you'd like to invest with me, you could come there also. Invest with me. Just go to Vinney Chopra /invest. Or if you like to learn from me, which I mastermind actually at 4 o'clock, I have a very good guest speaker, real estate attorney, CPA coming to my mastermind. I have hundreds of students who are doing millions of dollars. I'm so happy, who have taken my teachings and now they are doing 200, $300 million portfolios within 2 years, and 3 years. It's amazing. It's amazing. And it's not me, it's them. It's totally them. I tell them, I say, I knew you when you joined my academy. You were a mover and shaker, and they're doing very well.
That's great.
Thank
Well,
you.
Vinney, I can't say thanks enough for taking the time to connect and talk. It's always great to hear from you and talk with you.
Thank you.
I look forward to doing it again soon.
Totally, Darren. And if you're in Florida, love to invite you, brother. You come to Punta Gorda or Cape Coral. I'm purchasing that one. Palm Bay, Sebastian, Ocala, Venice. You name it. We are all over there.
We will talk here as soon as we're off here, because I've got some travels coming up. So
okay,
definitely.
Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.